Greetings and welcome to the new year of 2022 with this Advanced Projections Economic Review and Report. We hope your holidays were enjoyable and that you are now ready to get down to the business of monitoring the economy and managing your investments. So first, our December 2021 economic highlights in review consist of a half a dozen major items. The Federal Reserve and the pandemic continue to exert their respective forces on the economy, just as they did last month. And now the highly transmissible Omicron variant of COVID is burning its way through the global population just 2 months after it was first identified. Infrastructure spending will initially be slow to roll out as state legislatures will decide in early 2022 where they will be spending their apportionments. Inflation and employment figures for December and 2021 come in exactly as we have predicted. 7% for inflation and a tepid December employment result. Unemployment dropped to 3.9% due to previous labor force contractions, dropping to a level that has already made the Fed change focus as they confirm an accelerated pace of their asset purchase tapering through early 2022 and interest rate increases scheduled shortly thereafter. Equities climbed to a series of new all-time highs in December, but have since hesitated as less than desirable inflation and pandemic news continues to be made. Now, the details, year-over-year consumer price index comparisons and supply chain issues have continued to plague many aspects of the economy, keeping prices and inflation expectations elevated as demands remain above available supplies in many cases. CPI figures confirmed the onset of inflation during the second quarter of 2021, and they have continued to rise. Last month, we projected a non-seasonally adjusted CPI at year's end to be 279, up from 260.47 at the beginning of 2021. That implied an annual increase of 7%, which is going to get quite a bit of attention when the numbers were announced in mid-January. The actual CPI number came in at 278.8, and inflation was 7.04%. So we are going to claim an exactly correct prediction on both counts. Unemployment took another big dip down to 3.9% by the end of December, but job gains themselves were limited to just under 200,000. Some economists were predicting December gains of more than 4 times that much, so our prior comments about tepid job gains at the end of the year were again proven to be correct. We expect those gains to continue in a restrained fashion until the Omicron peak has come and gone, perhaps in late March, and then bump up with the ascent of warmer weather. We've seen others project that unemployment will reach 3.7% by the end of the year, but our own figures fall into the 3.3 to 3.5% range, keeping labor markets very tight. As we predicted, the Fed first announced in November that they would implement a gradual end to their asset purchases over the course of the next 8 months, going from $120 billion per month to zero in step reductions of $15 billion per month. As we also anticipated, the December update from the FOMC described how the Fed was going to accelerate their plan, ending their asset purchases by March instead of June, and that it would be reasonable to expect 3 25 basis point rate increases during the remainder of 2022. AP believes there will actually be 4 increases and that the final one may be 50 basis points instead of just 25. That would bring the Fed funds rate up from near zero to about 1.25% by the end of the year. 10-year Treasuries have already begun to reflect more aggressive expectations, with a 30-point increase in just the first part of January. Many traditional investors use action in the 10-year treasuries as harbingers of future equities market revaluations. With the jet-like entry and progression of the Omicron COVID variant, we are now experiencing over 700,000 new cases per day in the USA, with nearly 1,700 daily fatalities at the time of this report. These two rates have moved up significantly from mid-October lows, associated with a retreat to more indoor activities and gatherings, the beginning of winter weather, and many holiday gatherings. Omicron is not respecting any boundaries, as breakthrough infections, albeit mild ones, are occurring even among the fully vaccinated, as well as the recalcitrant unvaccinated. Hospitalizations and ICU occupations of victims are overwhelmingly from the unvaccinated. Third quarter earnings reports came in well ahead of expectations, with decent year-to-year comparisons against a dismal third quarter in 2020. Fourth quarter estimates have also improved. Actual reports will be more numerous by the time of our February and March reports. However, looking forward to later in 2022, the picture being painted by companies isn't nearly so rosy. Earnings increases in 2022 year over year are now being estimated at 9%, with about 5% growth in revenues. Companies have now returned to a more normal practice of citing lower expectations in the coming quarters. Here are the current underlying socioeconomic issues. The current employment picture in December, again, as we said, unemployment levels moved down to a national level of 3.9%, with a much smaller than expected job gain of just under 200,000. Recent data estimates show that businesses still have more than 10 million job openings that they want filled. However, a larger than normal number of people have recently retired or otherwise removed themselves from the search for work, and thus amplifies a decline in employment reflected in the just released 3.9% figure. The labor force participation rate had declined by 1.7% since February of 2020, just before the pandemic took hold, representing an active labor force decline of 2.7 million, some of which are due to a net balance of retirements, and the rest mostly due to the consequences of the pandemic. If the size of the active labor force had stayed constant, the effective unemployment rate would be higher at around 5.4%. In spite of those earlier exits from the labor force, the participation rate had begun to move upward again in the last fall. In December, the size of the labor force and the labor force participation rates stayed essentially even with November. Expectations for continuing improvement in employment and the labor force participation rate are still predicated on several assumptions, including no new COVID crisis, the national infrastructure package, which will assist by adding at least $120 billion per year, stimulating project-related employment, and on increasingly urgent corporate labor requirements to sustain their profit and revenue growth. Just as we had forecasted, a downward trend towards and now below an unemployment level of 4% would be viewed as a true full employment situation by the Federal Reserve. The significant declines below 5% had led it to first announce in November that they would begin a gradual end to their highly accommodative interest rate and money supply policies beginning in mid to late 2022. This was clearly stated in the FOMC, Federal Open Market Committee statement following their November 2nd and 3rd meeting, where they gave a scripted tapering down of their highly accommodative policies and then the associated near zero-term short-term interest rates beginning now and running through mid to late 2022. Just 6 weeks later, on December 15th, with unemployment heading rapidly down toward the 4% level and inflation heading up to 7%, they modified and accelerated their tapering program, which has been deemed a pretty hawkish anti-inflation move by many observers. This program is now designed to eliminate asset purchases by March of 2022 instead of mid-year, and to expect from 6 to 8 Fed funds quarter point rate hikes during 2022 and 2023. Now, we're just going to have one brief remark about the pandemic here. The details, which cover a couple of pages, are found in our written report, but in order to keep the audio report to a reasonable level, we're going to leave you to read those if you're interested in them. But here is the quick summary about the pandemic. By early January, total U.S. COVID fatalities reached nearly 850,000, up approximately 45,000 just in the month of December. Our projections made throughout this fall of 800,000 by December 1st was exactly on point. There are likely to be nearly 50,000 fatalities during this January based upon recent increases in cases and fatalities associated with the national and global spread of the new Omicron variant. In the U.S., the Omicron peak is likely to occur in the mid-February to mid-March timeframe and take several more weeks to wind down. Now, back to the normal economy and the equities markets. In December, equities markets managed to yet again push to new all-time records. It began to appear that speculators were completely ignoring the accelerated Federal Reserve plans to slow the growth of the money supply and increase interest rates. Markets held on to near record pricing through the end of the month. The first part of January has been a different story, however. S&P 500 earnings for the fourth quarter of 21 are just beginning to come in at this time. Financial sector results are the first to be reported and generally look very good, with results in the vicinity of 10% ahead of expectations. With increased interest rates on the horizon, banks should continue strong in the quarters ahead. For the balance of companies, there are similar year-over-year growth expectations for the fourth quarter, due to comparisons against a depressed fourth quarter of 2020. However, the markets should be looking 6 to 12 months ahead, and the estimates for S&P 500 earnings and revenue growth are far less aggressive, in the vicinity of 5% revenue growth and about 9% earnings growth. We have a chart included in our written report, courtesy of FactSet, which puts the 2020 through 2022 earnings growth picture in comparative perspective. Now, there may be more pleasant surprises showing up later in the second half of 2022, but businesses right now still face uphill challenges from supply chain constraints, temporarily higher energy and labor costs, as well as ongoing labor shortages. In the past year, the markets have only taken one short-lived break along the way to nosebleed territory from the lows set in 2020. But a return from the current bubble territory to warm market levels would take the S&P back down to about 3,500, and a correction to the mean would be near 2,800. We are still due for such a correction, but something will need to trigger it. The Fed's recent rescripting of their programs seemed to only make the markets more confident, and it's likely that something else will have to come along to rattle the confidence of market speculators. So instead, the S&P 500 briefly penetrated the 4,800 level near the end of last year. How long it will last there is just a guess at this time, but the first half of January saw this index trim off about 3%. Further price action depends on a whole host of interacting phenomenon, but historically speaking, as rates rise, stocks will eventually and generally move in the opposite direction. We monitor margin borrowing as one of our favorite tools for indicating speculative excesses in the equities markets. Heavy margin borrowing that is synchronizing with markets making significantly new highs is a likely strong leading symptom for a market correction. In November, margin borrowing dropped back 1.8% from the prior month's all-time high, so levels are still very, very high. We have included our typical chart for margin borrowing, which we take courtesy of Advisor Perspectives, and that is in our written report. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.